Tami Wollensak is a licensed mortgage loan originator and a divorce mortgage specialist with New American Funding. She helps divorcing women and men navigate their home equity solutions and mortgage options while they are going through the most challenging time of their life. Tami, welcome.
Thank you so much for having me, Tracy. I always love when we are able to talk.
Me too. And I want to talk first about being a certified divorce lending professional because I think it is such an important credential to have when we are talking about divorce. Someone who is going through a divorce really needs to be working with someone who knows the specific nuances of divorce. So tell us what it means to be a certified divorce lending professional.
So I like to tell, that's a great question. And I really like to tell people it bridges the gap between real estate and family law or divorce. There's a huge gap that a lot of times happens because family law attorneys and anybody that is guiding people through the process of divorce is not a mortgage lender. They don't know whether or not things can be carried out post divorce. So, a lot of times in agreements that people make, either very well meaning people, right? It's not that they're trying to do anything to derail people, but they just don't understand what all the nuances in mortgage lending and some of the gaps and blocks that can happen through some of the agreements that are made. So, a certified divorce lending professional kind of bridges that gap.
Right. So you have expertise in all those picky details about the divorce process and how to either assume a mortgage, refinance, get a new mortgage if you're going to buy a new residence. I think with the family lawyers that I work with, I hear things like, oh, you can just take over the mortgage. Or I hear them saying, well, you'll have 90 days to refinance or something like that, where number one, it's not just a matter of taking over the mortgage, and nor is it possible in some cases to get that refinance done in 90 days, right?
Oh, yeah, those things when you say that, it scares me because that is exactly the reason I kind of doubled down on this lane is because I was seeing a lot of legal binding documents that spelled out exactly what you're saying. Like somebody's going to refinance within 90 days. Well, in lending, sometimes there's some criteria as far as timelines to receive certain types of income and the ability to follow through on some of those agreements needs some planning involved because maybe there's some credit issues or maybe your one person is the person keeping the house is going to be receiving support, maintenance, alimony, child support, whatever it's called in your state. And there's certain criteria that need to be met in order for me as a lender to be able to use that as income. So, well-intentioned people that are trying to put agreements together don't know I may need 6 months of receipt of that support. So if they're agreeing to do something within 90 days, that's a problem. I can't do it. So there's a block right there, right? Like if you just wait 3 more months, you can potentially carry this out, but you put in a legal binding document this timeline that, can't be carried out. So,
Well, and I would even be in favor of going longer than the 6 months, maybe even saying a year, because
yeah.
you just need some time for some hiccups in the process. I think that a lot of the women that I work with in divorce are re entering the workforce. And so, okay, they're going to have income, but they have to qualify for that mortgage. And I think the lender wants to see a history of earnings. They don't just want to see your very first paycheck from that new job, right?
Yes, and that is one of the things that I do to analyze it. And you're right, a lot of people are rejoining the workforce, and depending on, what they did, maybe they did work previously and then started to stay home with the kids or whatever. And sometimes we can piece those two pieces together if they have some type of degree where they're going back to work in that same field. But sometimes they're just, changing careers or starting in a new thing or right now, a lot of times people think that they can start new businesses, right? I'm going to start this new business, and it's doing pretty well. I've had it for the last 6 months, and I have this amount of money going in my bank account. Well, as a lender, we don't use that type of income until we have a history of it for 2 years. So that can be another really, uncomfortable conversation that I have with people about, yeah, I know you're doing great at your business and I commend you for that. But unfortunately, from lending requirements require you to have 2-year history on tax returns for me to use that as earnings or as income.
So, if someone who's getting divorced comes to you early enough in the process to give you some time to go through the numbers and the legalities with them, are you able to work with their financial planner, with their attorney to try to make sure that these agreements are spelled out in the right way?
Yes, and I do a lot of times. I do. So I do all the planning for them, one on one, and we consult with what their goals are for their financial future and making sure that they're clear on what it means for different options. And then I put it together in a report that they can take back to their attorney or their financial advisor. I don't jump on calls with attorneys because that usually call costs them money, right? For me to go over all the information with them, but I'm more than happy to do that if somebody wants to bring me in on a case and explain exactly what I've spelled out for them. And financial advisors, the same thing. Financial advisors a lot of times help with the division of assets from a more holistic standpoint, from the whole thing. And I'm staying in my lane as far as just working with the house. So whether or not, if you need to do an equity buyout and you are going to give up other assets, in other words, to equalize that, I'm not the person to tell you whether that's a good idea or not. My lane is only to tell you what it looks like to do it. And then you make the best decision that's right for you and your family based on the other professionals that you might have on your team.
Well, the $1,000,000 question that everyone always wants the answer to is, how do I know if I can keep the house or not?
Yeah, that's a great question. So, planning comes into play, right? You need to look at and see what it takes to qualify to do it, how you split the equity. It's not really the house that people are winning, right? It's figuring out how to divide the equity. And once you explain that to people, it's the equity in the house. And I can explain that from a high level using numbers is if you have a house that's worth 500,000 and you owe 200,000, that $300,000 is what you're dividing in a divorce. And how you come up with the division of that, whether it be through other assets or through a new mortgage, is going to be what your post-divorce budget and payment was going to look like for you in order to keep the house, right? So, there's a lot of kind of moving parts to that.
Well, and then it's going to make a big difference whether you can just assume the current mortgage and keep your
Mhm.
same payment and interest rate, or whether you have to get a new mortgage, which in this day and age most likely will be at a higher interest rate than if you had a house that was purchased 5, 10 years ago, right?
Yeah, unless you were living under a rock in the last 5 years, most people have an interest rate that's, in the threes or 4% interest rate range. So when you're talking about assuming a mortgage, that's a term that a lot of people want to talk about. And what that means is exactly what you said. You're keeping the current rate, you're keeping the current principal balance, and you're keeping the current payment, right? All of that combined. But that doesn't mean that the lender that you're making your payment to allows this to happen. So there's the big thing. You have to go to the lender and you have to say, I am going through a divorce. Is my loan assumable? They're going to say yes or no. Here's the really broken part, Tracy. They will not tell you if you qualify without a divorce decree. They will not allow you to apply for an assumption without a divorce decree. So you have to make a lot of agreements, right? You have to put it in a legal binding document and all the things in order to get a divorce decree. So it's kind of like a catch-22. So I always tell people, even if that is what you decide, have a backup plan in your settlement agreement. It's really important that you don't just say, I'm going to assume the mortgage or sell, because what if you get denied for that assumption? The other thing that's really important that I'd like to get across to people is there's a cost to it. So even if you are able to assume your mortgage, know exactly what that cost is. It can be in the thousands of dollars. So if you're signing up to assume your mortgage, you better be ready to write a check, because it's not like a refinance. In a refinance transaction, a lot of times we roll those costs into the new loan, so you don't have to come to closing with a checkbook. Not with an assumption. You have to write because you're keeping the balance the way that it is. You're not rolling anything in. You're just keeping everything status quo. So
But if we do that refinance, now we're probably signing up for a higher interest rate, which is
yeah.
gonna impact our monthly payment and can really, from what I've seen, have a significant impact on that monthly payment, right?
It can, but it sometimes depends. I'm going through a transaction with one of my clients right now. She currently has a 15-year loan. It's at a great rate, right? But I'm amortizing the new loan over 30 years instead of 15. So it's giving her the stability that she needs from a housing payment perspective and a budgetary perspective to carry out what she needs. So it really needs to be looked at from a holistic standpoint, so that, and from a budgetary and cash flow perspective, right? Because people are going to have a housing budget, whether they rent, buy, buy out their spouse, do whatever. Most people have some type of housing payment that they have to make on a month-to-month basis. But what does that look like, and how do you structure it to where you're not house poor? We use that term. You don't want every month to be struggling with what is that mortgage payment going to be. Nobody wants that, and you don't want to sign up for that. So making sure that you make those decisions and are very clear before you put it in your settlement agreement, and say, and take any stand that you're going to go any direction. And then if it's the right answer for you and you feel comfortable with it, great. Then you can make the agreements, and it puts you in a position of power from a negotiation standpoint, right? Because you're going to go to the table and say, look, I can do this. I'm comfortable with it. I already spoke to somebody. I qualify. This is the timeline that needs to be met, and this is how I plan on doing it.
Well, what is the right process to follow so that we can figure out if we can truly afford to keep the house? Because I've seen a lot of scenarios where 6 months or a year down the road, someone is realizing, "Gosh, I really wasn't in a position to afford this, and now I'm stuck." So, what do you do to decide if you can really afford to keep the house?
I think working with a financial advisor or a planner, financial planner that can look at what all of and help you come up with a budget for yourself, because sometimes in a marriage it's a divide and conquer, and a lot of times one person hasn't been the money person. And so understanding what a budget looks like, and whether or not it's not just the mortgage payment you need to be concerned with, it's all the things that are required when you own real estate. There's maintenance items, utilities, like all of the things that you need to be prepared for, that doesn't put you in that situation, Tracy, where a year down the road, that's exactly what happened to me. And that's why I do what I do. I signed up for my marital home only to look at the mortgage payment and be like, yeah, I think I can swing that. And then all of the other items, I live in Illinois, so it's like fall cleanup, spring cleanup, snow removal, this, that, the other thing, constantly writing checks for things that I wasn't prepared for. So,
And then
um,
God forbid the hot water heater goes or you have
yeah,
some other major repair on the house.
right, right, right.
So I know that a lot of people think about keeping that marital home for the kids. The kids are going to be going through a lot of changes because of the divorce, but the home is the one stable thing that I can keep for them and they can keep their bedrooms, and that's going to make it much less difficult for the kids. I know you have some thoughts on that.
I do because this is the reason I did that as well. I'm very empathetic to that about people doing it for their children. And sometimes it's their only thing that they feel comfortable with. It's their community, it's their neighbors, it's their whatever they've established. And I feel that putting the oxygen mask on yourself is really important in those situations. And I can tell you from experience that if you are house poor or stressed by payments or, maintenance items or things that are going to come up on this real estate, that it's not going to be the best things for the kids. Because if every month you're having to come up with how you're going to make the mortgage payment, the kids don't stop. They still want their, Chipotle, and they still want all the things that they continue to want. They're going to continue to ask for. So, if you can figure it out from a financial perspective, put the oxygen mask on yourself, look at it from a financial and business perspective, and then make some decisions based on that. The kids will feel your stress if you take on more than is necessary.
I know that people feel like rent is expensive. Oh gosh, we're going to pay almost as much in rent as we would pay in the mortgage payment. But they forget the rent is, for the most part, the end of it. You don't pay for any repairs. You don't pay for snow removal. You don't pay for the leaking roof. You pay rent and you know exactly what your cost is every month. So I think people really forget that there are some great benefits to being a renter.
I agree. And I think that being a renter sometimes helps you to get a reset and establish what your budget really needs to be without the stress of big ticket items that you need to write a check for. And you're right, it helps you create a much stronger realistic budget because there's no, you can call the maintenance guy if your light bulbs go out, or you don't have to pick up the phone if the toilet's clogged or whatever. You just call somebody and they come fix it. So, I'm a big advocate for that, especially through the process of divorce um, and kind of getting a sense of your own personal finances if that hasn't been something you've been involved in.
Well, and of course, just giving yourself a little bit of breathing room and some time to decompress from the situation before you make a huge decision that could impact you financially. That being said, there are people who really want to have home ownership. And so the next option that I think people don't look at often enough is buying a new home, buying a different home rather than staying in the family home. There
Mhm.
are some benefits to getting a different home, right?
Yeah, I love this question because I love to tell this because so few loan officers even know this, and because I focus on this area, I'm able to offer this solution for people that they're like, "Oh, really? I didn't know that." So through the process of divorce, even though you own a home today, let's say you own a marital home and you get a divorce, you qualify again as what we call in the lending industry a first-time home buyer. You're not a first-time buyer, you're actually displaced. You're a displaced homeowner. You had to make a decision regarding your housing needs. And so, from a lending perspective, Fannie Mae and Freddie Mac, if you've heard of those terms, they have a guideline that allows you to qualify again with a smaller down payment, You get some interest rate reduction. You get private mortgage insurance reduction. It is income qualified, so you have to be within a certain range of income for your area, and that's something that I can look at. But you're able to take, let's say, the equity in your house, absorb the cost of the sale with your spouse, or get bought out, whatever. Take that money, establish a smaller housing budget for yourself, and maybe you don't use all that money. Maybe you use a smaller portion of that money. And then now you not only have a house, but you have a slush fund or an emergency fund for yourself because you took that asset and you put a little bit of it into the new property, and you have some other money that maybe is in a savings account or somewhere that you can pull from if there's an emergency.
Well, the accountant in me loves the concept of potentially downsizing too. What I see in divorces is most of the time, you do not need as large of a house after the divorce. And so buying a smaller place makes it easier to maintain, probably gives you a lower cost for the house itself. It helps limit some of the repair costs and upkeep costs and things like that. So buying a new home can have a lot of really good financial impacts, and here's the one that goes to the heart. There the fresh start that you can have in a new home to me is priceless.
Totally. I think so too. I think women, a lot of times in particular, hold on to a lot of the memories in the home, and there's a lot of good, right? There's a lot of, but you forget there's sometimes not so great memories in the home, right? And a fresh start helps you reset that. So kind of putting that part to bed, so to speak, and allowing yourself to have a fresh new start with a new home, decorate it the way you want. Go get that flowery comforter or whatever you want to do, right? Allows you to, have a little bit of breathing room and create a space for yourself that feels like your own, right? Rather than your
Right.
your old marital home.
Tammy, I know you have a guide to divorce and real estate that you're
I
going to be
do.
sharing with our listeners. I will link to it in the show notes, but I want to have you tell us a little bit about that resource.
So I came up with this resource because I was answering a lot of the same questions kind of over and over and over again. And I feel like it empowers people to read through the guide and kind of get a lot of the things that we're talking about today from a high level. And then if you want to do one-on-one planning with me, that's great. But at least you have a lot of the information, and you can go to your current lender if that's what you want to do from an assumption, and you can kind of understand some of the concepts. And I put in it a lot of the things to be aware of or conscientious of in the guide. So I love the guide and I'm super excited about it.
Well, I've seen this resource and it is one of the best out there when it comes to real estate, mortgages, and divorce. Tammy, you are a wealth of information and you are always so kind to give of your time and of your knowledge. Thank you so much.
Thanks for all you do, Tracy. It was a pleasure.